Much for joining us.
It's my pleasure, Wilf. Good to see you again.
I hope you caught Stephanie Link's very kind compliments there just before we joined you.
I think I caught it, but if they were good, I must have heard them.
Yeah, exactly. We're going to start, Brian, if we may, on the sort of macro picture. I interviewed you on December the 4th at the Goldman Sachs conference. You were very upbeat then about your outlook for the U.S. economy in 2019. Are you still as upbeat?
Yeah, we still have our experts for the U.S. for 19 at 2.2. That's probably come down from when we were talking there by, 0.3, 0.4, and that's largely due to the slowdown around the world and the trade and all the things we talked about back then. But I was hearing your colleagues talk about, if you look at consumer spending and you think about 16, 17, 18, and now 19, you saw it grow through the peak at 18. It's now consistent where it was in 16, 17, sort of growing at 5% in our card spending and our use of cash as opposed to 8%. And that's consistent with the economy slowing down. What we don't know, and will take a while to find out, is what was the impact of the shutdown and things in the first month of the year in terms of just enthusiasm in December, your colleagues were talking about, as we see that play out. But you're seeing with mortgages picking back up, you're seeing the consumer in the game, continuing to spend. It's the biggest economy in the world, almost by itself, and we consider to be constructive on growth.
To the point of the consumer, I mean, retail sales data came out yesterday for February and significantly disappointed. You're always very up to speed on what consumers are doing. What have you seen for February and in March?
And so what's interesting is they were lower in February, but they restated the month prior, which we all wrung our hands about up. And so this data is hard, and I ask our economists all the time, how come it gets moved around, considering that other data doesn't. But if you look at Bank of America's data, which will be $3 trillion of money spent on credit, debit cards, ATM cash out, teller cash out, checks written, P2P transfer in a year, that is going to grow 5-ish%, 4.5% to 5% for this quarter. That's all forms of cash, digital growing faster and non-digital, and that's consistent more with a 2% type of growth economy as opposed to 3% we had last year.
Larry Kudlow was on CNBC last week. He called for a 50 basis point Fed rate cut. Do you think that's warranted? I
think that the economy is growing. The Fed is trying to get themselves more to neutral. That's what they've said. I think the goal of the Fed is, their charter is not to try to push the economy. It's to make sure the economy, price stability, unemployment, things like that. And I think that's where we are. We're kind of to a 2% plus growth economy, and we've got low unemployment, and wages are growing faster than people think, and people are spending. I think they're playing it the way you should, is just let the data tell you what to do. And they were clear about that. The market's gone back and forth, but they've always been clear that when they got in this range, they're going to pause to take a look at what happens next. And that's the thing we have to be focused on, what happens next, and that's the type of data you're talking about. So
the economy, from all the data you're seeing, is not in any kind of emergency scenario that warrants further immediate action?
No, the big debate here is we're slowing down. And we're slowing down a little faster than what people had predicted before the trade wars and stuff, and some of the stuff that happened at the end of last year. The reality is that's coming back through the system, and I think if things fall in place with agreements with China and other things, you'd see that would sort of fade to black and go away from people's memories. But right now, that's what caused people and the activity to slow down. The rest of the world is more interesting. It's slowed down to 3.3% in our projection for 19. We're probably as high as 3.8, to the early fourth quarter last year. That is a large part due to it being more affected by these elements than the United States. But the United States economy is strong. It's growing. More people are working now than ever. The unemployment claims are low. Wages are growing fast. Our wages have grown 6% per annum for the people in our company that are below medium wage in our company and down. I mean, it's a good place right now, and I don't think we need to juice it. I think got to let the economy work.
When you see how your share price and your peer group share prices reacted, do you think banks investors overreact about the shape of the yield curve and what it means to banks?
Well, the question is, if you're an investor that believes that because it inverts and becomes flat, that a recession's coming, you can understand that because banks are going to reflect to some degree the recession through their P&L because we transmit the economy. We don't drive the economy. We transmit the economy between consumers and companies and employers and their people and investors in the market. And so that's what you're going to see. I don't subscribe to that, and I don't think most people do. But if you believe that that's the output, you'd say, yeah, they may have to move, but that's not what is in the data right now. That's not what we see going on right now. And time will tell. We are at 2.2%. You'd have to look back and say that growth rate is as high as it's been in almost every year since past the initial recovery after the crisis. That's okay. Do we want it to be faster? Everybody does. That's easy. Life would be easy if it were faster. But the reality is it is growing, and it's growing strong. That's the debate. Is it growing and keeping going down, or is it flattening out? We see it flattening out, and we see the consumer spending kind of consistent with that.
Let's talk about the banking industry more broadly. The BB&T SunTrust merger, the combined entity is going to operate very much in your geographic footprint. Do you see that as leading to more competition for you or less competition for you in that region?
You know, Kelly and Bill run two great banks we compete with every day, and so I don't think it changes. You know, I think we compete in all our markets against a variety of competitors, the big ones, the small ones, the medium-sized one. We're here at the CBA in that audience of 1,000 people that you and I will talk to in a while. It's every participant, and this industry will always have that variability to it, like other industries do. Local drugstores and the national chains, local hardware stores and the national chains, local diners and the national chains. And that's what's going to happen. So it doesn't change our view of our capabilities. It might change other people's view of what's going to happen in the industry. And as you know, back when I think we were talking in Davos, you know, I said I could see consolidation taking hold largely because the economies of scale for those people that are bigger to get bigger is really important. Doesn't mean other people won't be able to play and have be very successful.
I want to talk about capital markets. Sergio Motti of UBS described Q1 as one of the worst environments he's ever witnessed. Do you think he's talking about Europe there as opposed to the US for this past quarter?
I'll let Sergio speak for themselves, but you know, all our peers and we are in the same range have said we're coming down year over year. You got to remember last year, first quarter after tax reform passed and the end of 17 without much belief it could. It passed. That was a pretty strong equities business in the first quarter of 18. That has come off. We're down 20-odd% from that. Overall, we're down 15% or so probably. But if you think about that, what we'll do this quarter is consistent with the last 10 quarters average. So it ebbs and flows. The question on my mind is this more like a 16 where the first quarter was not so good and the second quarter was better because the government shut down and the activity pushed to the second quarter. Then it wasn't the government shutdown, it was other things, but it pushed the second quarter. Or is it a case where the markets are more muted? As you saw March pick back up, you said it's probably more of a case where, as we always say, last year's first quarter is this year's second quarter. I think you'll see better going ahead because you've seen during the month of March, it was a little ugly in December. January, with a shutdown, things couldn't get done, new issues, the SEC wasn't open. Then you start to pick back up. We feel pretty good right now, but it's going to be in that range.
Wanted to ask about the Lyft IPO, down 7% from the IPO price, down 24% from its peak on the first day of trade. Does that damage the prospects of the IPO pipeline, given that it's had such a soft first couple of days trade?
You know, I think these are driven by the institutional markets, and they have their views of valuation of the companies, and they'll buy them or not. And then the retail comes in. This gets into trying to evaluate a company. I haven't spent any time trying to understand their financials, so I'd leave that to others in our team to do it. But you know, I think it's always better to have stocks relatively sound after an offering because that means the investors will have more enthusiasm. That's a great debate of how you run an IPO that you guys have been talking about. In the end of the day, this is all the first 3 days of trading or whatever. The question for these companies, as our company, is what are you going to do long term, and that will play out.
Final question, Brian. You're back here next week for a hearing in front of the House Financial Services Committee, and just last week, your peer Tim Sloan retired in part due to serious political pressure. Is there a part of you that looks at this and thinks, for us, for banks, the political pressure was 10 years ago, we've been through this, and this is unwarranted and unfair to be facing it again?
Oh, it's never unwarranted and unfair. We have a special purpose and charter, and that's to serve communities and to share our success with those communities. And so when that's what you do every day, to help the core economy activity take place, it's obviously the policymakers are going to be interested in a given moment what's going on. And so, you know, the scrutiny across the last 10 years and before has always, you know, been consumer questions, how to get more mortgage loans out there. Today we announced a $5 billion program to get more down payment qualifications. Didn't change credit, didn't change FICO score qualifications, prime customers, but we're helping them get down payment relief faster so they can get into the houses faster. You know, that's one thing. The other people were worried about the capital market side and that stuff. So it's fair to be asked these questions. In the end of the day, if you look from a decade, our industry is extremely strong, and you can see that in the stress tests, things that didn't exist, the resolution plans, the stress tests, the capital levels. We have probably 3 times as much capital. We're 25 to 30% smaller than we were pro forma for Merrill Lynch today.
That's the regulators' ballpark, though. What about the politicians? I mean, did Tim Sloan face undue personal pressure?
You know, look, Tim was a colleague, and I enjoyed working with him, and we did some fun things together like Zelle and these things over the years. Look, I had some fun with the political pressure. Again, we face political pressure all the time. That's part of the job, and I think, but it's really part of what we do. In the end of the day, because we're so embedded in the fabric of America economy as banks, this is part of the job description, and so we'll get a chance to tell our story.